Welcome back, listeners. My name is Larry Kolvig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you're listening to the Haven Financial Group radio show, where weekly we discuss crucial retirement and financial topics that can make the difference between surviving retirement and thriving through it. Kim, this week just happened to be interest rates, inflation, all those wonderful topics that we continue to talk about because they're ever changing and they're applicable to everybody, but for sure, those that are planning for retirement.
Absolutely. Kyle Thomas is with us, a certified financial planner with Haven Financial Group. We're always happy to have his expertise. We have been talking about interest rates. Of course, Federal Reserve lowering interest rates for a second time this year, about a week and a half ago. And there is talk that there could be another interest rate drop, possibly this year, if not this year, early in 26. We've talked a little bit about the impact that this has on retirees and pre-retirees, but let's talk a little bit, if we could, gentlemen, about the impact that these lower interest rates and the Fed's decisions are having on the economy. Inflation, as you said, Larry, is something that we have been talking about nonstop. So if interest rates start to come down, talk to us about what that does for inflation and then ultimately for the economy as a whole.
Yeah, so reduced interest rates or lowering interest rates definitely stimulate an economy. So when the Fed does that, they're trying to just pump more spending essentially into the economy. And so it encourages banks to lend more, increasing the money supply that's out there in the economy. And, as spending increases, demand for goods and services rise, and that can potentially push the prices of goods upwards. So that's, the inflationary aspect there that can happen with lowering rates. They tend to stimulate economic activity pretty well. And, that's where that inflation comes from. But when they're reduced, the borrowing becomes cheaper for businesses and consumers as well. So it's more money in your own pocket and in these companies' pockets. When rates went up back in 2022, that isn't as good for anybody, right? Companies hurt from that. We all hurt from that. But some of the big companies, they actually did okay because they weren't borrowing. They had cash. Think about Apple and Amazon, all those big companies, they have cash on hand. So they didn't necessarily hurt from that. It's all the companies and people who don't have the cash on hand that really get impacted by that. So when rates come down, everyone tends to do well and stimulates that economy for thriving economy here.
A lot of people think that for such a long time, our interest rates were down, 3%, something like that. It was just so low. It's crazy. That's not always great for the economy, right?
We do want some inflation, right? We want it to be a modest amount, and that's what the Fed is trying to get, and trying to match that inflation number with the interest rates, because that's part of that dual mandate, right? Is making sure that our labor market's good and that inflation's at a good spot, and they're controlling an interest rate to find that sweet spot with those. So we do want a little bit of everything there, interest rates and inflation, because that's what actually spurs our economy to grow. But we just don't want it to be what it was a few years back at 8 or 9%, because that's where it gets really hard, and it costs a lot of money to borrow, which makes people not want to spend, which makes businesses go out of business because people aren't buying their products, and that's just a downfall for the economy. So that's why it was such a important task for them to get these interest rates down these last few years.
One thing to add there, lower interest rates, caution, can discourage saving and encourage spending. Well, as retirement planners, we don't want to discourage saving because we're saving for retirement, and we're not always going to encourage more spending. Incidentally, though, we do have conversations with folks that have done a good job of saving, and I'll say, are you spending anything? No, not really. And they probably never will spend anything because it's not in their nature to spend a penny. But there's others that have no problem spending. So word to the wise there, don't stop saving just because the interest rates go lower. And don't start spending just to spend. Adhere to that budget that I've talked about numerous times in shows. Again, we want a good, balanced retirement plan, a good approach, and that doesn't change just because interest rates go up or they go down.
Yeah. Guess which one of those categories I fall into there, Larry? I think you probably have a pretty good idea. My husband knows for sure.
I care not to say on the air.
So having said all of that, our Econ, 101 class for the folks who are listening, the idea behind this is that obviously there is fluctuation, there's constant change, and this is going to happen. It's happening now. It has happened in the past. This is going to happen in the future. So when they come in and we sit down with you guys and say, hey, I'm about ready to retire and I need to put together a really great plan. How do you plan for this constant change of interest rates and inflation, and the economy is strong and it's weaker? How do you plan for that?
Yeah, it all comes back to our initial, meetings and making sure that your goals are in our analysis and that we're planning for that. And then we go from there and we try to figure out what are our needs and what do we want this to look like for the next 30 years? Because we want to be stress testing for a long time. And typically it's, 30 to 35 years in retirement that we're planning for, because we want to make sure we don't run out. But with all of those assumptions of spending and the asset base that we have and all the income sources, we stress test that out over 1,000 different trials of market scenarios. And these market scenarios have really bad markets. Think about 08, 09 happening multiple times, in the worst case of those scenarios. And then maybe some really good scenarios like the last 2 years happening a lot of times, and or like the tech bubble, right? And everything in between. So 1,000 different trials, and we try to get a success rate of 75 or higher. So that means 750 of the 1,000 trials or higher would be a success, which means not running out of money. Mm-hmm. And so that's the best way for us to look at it. Because if we go in and check on that success rate every single year and we don't go below 75, well, we're probably going to be fine for the rest of our lives, right? Because the closer you get to that end time of, that 30-year time horizon, the closer you get to the end, the more accurate you're getting every single year. So naturally that 75% would go up, even if, your spending habits stay the same. Mm-hmm. Each year you live, that success rate would go up. So that's how we do it and make sure people are on track and make sure that we're accounting for all these different types of scenarios that could happen.
Larry, this is why it's so important for people to partner with folks like you guys at Haven so that these kinds of tests can be run and this kind of planning can happen. Because again, life is going to happen and changes are going to continue to exist.
It's always happened. It's going to continue to happen. But if you're not getting the attention, if you truly are not sitting down with somebody a few times a year to talk through these things, you owe it to yourself maybe to get a second opinion. Maybe you're not in the right spot because you should be getting that attention, somebody to hold your hand, not because you have to have your hand held, but maybe you do. Maybe you haven't looked at it a long time. If you're doing the same things you did 30 years ago and you haven't changed anything, it's probably due for an overhaul or some sort of change. Change isn't always fun. I continue to hear sometimes people when we don't want to go to a financial person because we fear that they're going to sell us something. We're a retirement planning firm. Our goal isn't to sell you anything. Our goal is to develop a long-term relationship where you feel comfortable talking about any of these topics. I love when somebody, and I hear it often, wow, it's so nice that you have in your office, a CPA, tax planner, estate planner, investment team, all the insurance products where we can help in all these different areas. And thankfully, 10 years into this at Haven Financial Group, we have multiple personalities. You will get the attention. And I love when I hear folks say, wow, this is so comfortable here. It's so comfortable. It feels so homey. Yet it's so much fun. If you can't say that where you're at right now, you may owe it to yourself to get a second opinion.
And I'm going to bet a whole lot of people listening, the last word they use is fun when it comes to this kind of thing. So I love that. 612-504-8400. Tell them you heard us here on the radio. When we come back, we're going to talk about the most costly mistakes that you want to avoid as interest rates start to come down. This is the Haven Financial Group Radio Show.